All right, let's dive right in. Today, we're going to tackle one of the most crucial skills in trading, how to actually read price action straight from the charts. Our goal here is to decode the story the market is telling us, moment by moment, without getting bogged down by a bunch of complicated indicators. You know, when you first look at a price chart, it's so easy to feel completely overwhelmed. Is it all just chaotic, a random series of ups and downs? A lot of traders get stuck right here, seeing nothing but noise and confusion. But what if it's not noise at all? What if it's actually a language? A language that, once you understand its basic grammar, tells you a super clear story about who's in control, the buyers or the sellers. Today, we're going to learn the two core parts of this market language. And those two components are structure and pattern. Seriously, think of them as the fundamental grammar of the market. If you can learn to clearly see the difference between these two, you are already way ahead of the game. So, first up is structure. The best way to think about this is as the market's long-term memory. It's defined by the most obvious significant turning points in the past. We're talking major swing highs and swing lows. These are the historical price levels that literally everyone is watching, the levels the market remembers. And then we've got pattern. Now, if structure is that long-term memory, pattern is the market's short-term momentum. It's the immediate flow of the price. What's happening right now? You can usually capture this by drawing simple trend lines or channels that show the current conversation between buyers and sellers. So to put it really simply, structure provides the major landmarks on our map. Pattern tells us which direction the car is driving at this very moment. You need both, for sure, but they reveal totally different things about where the market might be heading. Okay, so we've got our landmarks and our current direction. But what happens when the car suddenly just swerves off the road? Well, that's what we call a breakout, and it's a critical signal that the market story is about to change. A break is simply the price moving decisively past one of these levels we've been talking about. When it blows past a trend line, we call that a pattern break, or a PB for short. When it smashes through a major swing high or low, that's a structure break, or an SB. These are like the market's exclamation points. They're signaling a potential shift in control. Now, knowing a break happened is one thing, but knowing what to do about it, that is everything. And that brings us to the most practical, powerful part of this whole explainer, a simple framework for actually making a decision. Picture this. The price breaks a pattern line. Your heart starts racing. Do you jump in? Do you wait? This is that moment of truth, right? And the hesitation can be paralyzing. But what if there was a simple rule to guide you? Well, there is, and it all comes down to one number: 5%. This little number is the key to an objective, stress-free decision-making framework for any breakout you see. Here's the rule. It's so simple. You've got two key levels, the pattern line and the structure level. Okay, so if the price breaks that first level and the distance to the second level is more than 5%, that's a green light. That's a valid entry. You can take the trade on that first break and aim for the second level as your target. There's enough room, enough profit potential to make it worth your while. But what if that distance is really tight? If the distance between the first break and the second break is less than 5%, the rule completely flips. You have to ignore the first break. Seriously, just ignore it. It's likely a trap with way too much risk. Instead, you wait for the price to break the second level. That's your confirmation that the move has real power behind it. And the best part is, this 5% rule isn't just for one particular setup. It's a system of logic that applies across a ton of different market conditions. So let's take a look at a quick cheat sheet for how to use it. And here it is. This table is basically your ultimate cheat sheet for putting all these ideas together. It maps out 9 common scenarios you'll see. The sequence columns show you the order of breaks to look for. Is it a pattern break, a PB, then a structure break, an SB, or the other way around? And that priority column, that's your action plan. When it says 5% rule, you use the distance logic we just covered. We won't go through all 9 right now, but this gives you an incredibly powerful framework to analyze any chart. Now there's one really crucial insight from that cheat sheet I want to point out. It's this one right here. When the market range is expanding, you'll hear people call it a megaphone. The source material is very, very clear. This is a non-tradable situation. The risk goes through the roof. You know, sometimes the smartest trade you can make is no trade at all. Okay, there is one final piece to this puzzle. After a breakout, how does the market confirm that the move is actually real and not just a fake out? Well, it does that with something called a retest. And check out this powerful observation from the source material. 99% of the time, there is only one retest. That's a huge detail. It means the market will often give you 1 second chance to get on board, but it's pretty rare that it'll give you a third.
So, a retest is just the price coming back to visit the level it just broke. A pattern retest, or PR, is when it comes back to that old trend line. A structure retest, an SR, is when it comes all the way back to that old swing high or low. When the price holds at this retest and then starts to move away again, that is a powerful confirmation that the breakout is the real deal.
So there you have it. We've covered structure, pattern, the breakout, the 5% rule, and the retest. You now have the grammar and the vocabulary of price action. The only question left is, are you ready to start reading the story the market is telling you?